This is what comes next from the Fed. Impact on markets? Wall Street will pay close attention to the central bank's economic predictions when another big rate hike is likely. This week, the Federal Reserve is likely to raise interest rates by a huge amount for the third time in a row. This is part of its most aggressive fight against inflation since the 1980s, and it could be a sign of more to come. In today's video, we'll talk about what the Fed will do next, how it affects markets. Subscribe to Billionaire Crypto Investor to make sure you get all the latest news. So, let's get started without any further ado. First, let's figure out what the Fed is doing in the stock market. The Fed is made up of 12 regional banks, and it's in charge of setting monetary policy, monitoring and regulating financial institutions, and keeping the banking and financial system stable by acting as a lender of last resort. When it comes to the central bank, most people think that they will raise interest rates by 3/4 of a percentage point at their meeting on Wednesday. Some investors even think that there's a small chance that they will move by a full percentage point. But Wall Street is more interested in what is going to happen next. This week, after a 2-day meeting, officials will put out updated economic forecasts for the first time since June. As fast inflation continues to hurt the U.S., these are expected to show that rates will go up more quickly than Fed officials had thought before. How much more assertive will the Fed be, is the question. Central bankers have already raised interest rates a lot to slow down the economy and keep prices from going up too fast. In response, business activity is slowing down, but it's not falling off a cliff. Employers are still hiring, wages are going up, and inflation has stayed stubbornly high. Because of this, government leaders have said in speeches that they are serious about bringing price increases under control, even if it hurts growth in the job market. Many people on Wall Street call this hawkish because of the way it talks about inflation. The economic forecast could give policymakers a chance to show how committed they are to this goal. Kennedy Goldberg, a U.S. rate strategist at TD Securities, said, "Things aren't going quite the way they thought they would. They're having trouble slowing down the economy. At the end of the day, there's not much they can do this week besides sound like they're worried." The chair of the Fed, Jerome H. Powell, will hold a news conference after the report comes out. He is likely to repeat what he said at the end of last month, that the Fed will do whatever it takes to bring prices down. Mr. Powell has said that this could be a hard thing to do. Higher interest rates slow down inflation by making it more expensive to borrow money. This makes it less likely that people will buy more things or that businesses will grow. That slows the growth of wages and can even make unemployment go up. When the economy slows down, firms can't charge as much and inflation goes down. Mr. Powell said last month that higher interest rates, slower growth, and a weaker job market will all bring down inflation, but they will also hurt households and businesses. He said later, "We'll keep working until we're sure the job is done." If the Fed keeps raising interest rates in the way that economists and investors are increasingly expecting, the results could be bad. When inflation was last as high as it is now in the early 1980s, the central bank, led by Paul A. Volcker, raised borrowing costs sharply. This threw the economy into a recession and caused unemployment to reach double digits. Home builders sent Mr. Volcker 2x4s from houses they couldn't finish, and car dealers sent keys from cars they couldn't sell. This year's rate hikes are not as big as last year's. Since March, when rates were close to zero, the Fed has raised them to a range of 2.25 to 2.5%. This week, they're likely to raise them again to a range of 3 to 3.25%. If the central bank raises rates as much as investors expect over the next few months, they'll end the year well above 4%. Rates went from 9% to 19% in the 1980s. Still, 4 full percentage points of rate increases in 10 months would be the fastest policy change since Mr. Volcker's campaign. Fed policymakers have been hoping that they can slow the economy down without causing a painful recession, but economists have been warning that this is becoming less likely. This country's central bank has made it clear that it has to do something to stop inflation. The Fed wants to make sure there are as many jobs as possible and that inflation stays around 2%. Even though unemployment is very low right now, prices are going up at a rate that's more than 3 times the Fed's target rate and stayed very fast and wide in August. As inflation kept going up month after month, the Fed kept making its response stronger. It raised rates by 0.25 points in March, 0.50 points in May, and 0.75 points at each of its last 2 meetings. Many economists agree with investors that a 1-point change is possible, but not likely this week. One important reason to raise rates quickly is to show businesses and consumers that the central bank is serious about stopping prices from going up too quickly. If workers start to think that inflation will last, they may ask for higher wages to cover their costs, which employers then pass on to customers in the form of higher prices, starting a spiral that goes up and up. In this area, the Fed recently got some good news. People's expectations of inflation have been going down. Michael Feroli, a chief U.S. economist at J.P. Morgan, said this could be one reason why the central bank will choose a 3/4 point change over a bigger change at this meeting. This isn't about controlling people's emotions. It's about slowing down the economy, which can be done in a more planned way, he said. Because of this, Wall Street is likely to pay close attention to the Fed's predictions for interest rates for the rest of 2022 and beyond. People often call these predictions dot plots because they show the anonymous predictions of each policymaker as blue dots on a graph. Officials say they would raise interest rates to 3.4% this year in June. They are almost at that number now, which suggests that the forecast will be introduced. They also thought that next year they would raise interest rates to 3.8% before lowering them again. Since inflation's been going on for a long time, economists have come to expect that the peak rate will go up. The new level will show how hard the central bank plans to tighten its grip on the economy. Fed officials want to make policy changes that are strong enough to bring inflation under control, but not so strong that they hurt the economy more than they need to. It can be hard to find the right balance. It takes time for Fed policy to spread throughout the economy. Even though rate hikes have already started to hurt the housing market and overall growth is starting to slow, it might take a while for the full effects of the central bank's recent moves to be felt. The less likely a soft landing is, the faster the Fed raises interest rates, Mr. Goldberg said, because officials don't wait to see how their moves work out. It's a lot like realizing you missed your exit a mile back on the highway. Given that risk and how much rates have already changed this year, many economists think that the Fed may soon want to slow down the rate of increases. Mr. Goldberg thinks the market will go up by another 3/4 point in November and then go down by 0.5 point in December. Economists at Goldman Sachs said in a note this week that they thought the Fed would raise interest rates by 0.5 point at each of the next 2 meetings after this one. This would bring the federal funds rate to a range of 4 to 4.25% by the end of the year. The slowdown will happen because the funds rate will be higher, concern about over-tightening will eventually rise, and the drop in consumer inflation expectations should reduce concern about unanchoring, the Goldman economist wrote. But officials have made it clear more than once that even after they slow down and stop raising rates, they plan to keep borrowing costs at a high level that hurts the economy for a while. Did the Fed still have the same effect? Please let us know what you think in the comment section below. So, I have to say goodbye to you all for today. We'd be very happy if you like this video, but we can't keep doing these without your help. So if you want to see more amazing videos, please make sure you like our video and share it with your friends and family and other financial fans who are in your inner circle. And also, make sure you please subscribe to our YouTube channel by pressing that bell icon. That way you will always be notified of our latest updates and uploads on our channel. Again, we sincerely appreciate you spending time with us today, and we'll look forward to catching up with you in our next video. Have a great rest of your day, and thank you for watching.